Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey everybody, thank you so much for joining us. It is Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht and our options mentor extraordinaire with a very, very important market structure kind of view of what's happening with indices. We also go over sectors and individual stocks. We also take your questions. We have a little catch up to do because last week he was off and we've gone nowhere fast, big picture, after 2 weeks of sideways and then a tariff tease on Sunday evening, which caused this kind of short-term jump risk of 100 points on Monday. We petered out right at that kind of 57.83 area, which I had given prior. Basically, this is a really stronger resistance than I even expected because we not only softened this morning, but we broke through the 3-day and went right into the 8-day, which had been a price target for this week if we get rejected at 57.83. So we hit it today on, again, some tariff news coming forward a little bit. We've got a budget right now bill that's getting wrapped up with a debt ceiling inclusion, and it's actually very dangerous for our fiscal spending structure and what that means for yield. So we'll talk about that a little bit, but we've had a walk up in the yields, and equities had been positively correlated with a rising 10-year US yield. But today I think it was a little bit different. I think they got scared on both tariffs and the GOP kind of pushing forward with this bill with debt ceiling included, which really isn't supposed to happen until more like August. So anyway, long story short, we had a mercurial market reaction to tariffs on again, off again, delayed. April 2nd is coming, and there isn't any volatility really priced in to this binary event. Maybe the market doesn't trust that Trump is going to actually follow through, but we have jump risk up and down. Hans, what are you seeing? Because you had actually said when we did this title on Monday, you said, yeah, because we're definitely not out of the woods. What did you see and what are you seeing next?
Yeah, we're not out of the woods. Well, it's, my kind of analogy that I borrowed directly from you. I said, listen, the light at the end of the tunnel short term is going to be into a bounce. We saw even with those few extra final remaining days, down days in the S&P a week and a half ago, we saw the VIX start to relax. We saw that fixed strike vol start to relax, meaning those out of the money puts, basically those implied volatilities coming down a little bit. So that really signaled a relaxation. We saw some pretty bearish signals out there, sort of from the AAII sentiment, people really as bearish as they were.
Consumer sentiment.
Yeah, consumer sentiment is about as bad. I mean, people have really reacted quite strongly to the shock of the situation, and I don't blame them. It was really a 180 in terms of what people kind of thought they were going to get, and the Trump put, and he's got our backs, and he's all about the economy, and he's a friend to the stock market and everybody and asset holders. And it really was this complete, almost different 180-degree change in personality, essentially saying, wait, I don't care about the market. I care about Main Street, and I care about fixing some things that I think need to be fixed. And so the market didn't like that. But what was interesting about it was it wasn't really so much a volatility event like it was last August, September, or December. We had a very, very kind of orderly reaction from the VIX, which I did not foresee because we saw those dealers being short quite a few upside calls. And I kind of thought that we'd have that beta of VIX to S&P downside, which we really didn't get. And I think it was, I read this recently, it was something like one of the first times ever that we've had a 10% sell-off in under 30 days, that we didn't have the VIX surpass 30. I think we almost touched 30, but we didn't quite get past it. And it certainly, the high 20s were very short-lived. So it was very, very orderly. And lately we've seen a complete collapse in the VIX complex. The VVIX got down to levels that we hadn't seen since something like early last July, before all of the sort of AI stuff started to kind of fray a little bit. Yeah, the yen carry trade, all that before that. I mean, we really tossed out any kind of semblance of fear that we thought we might have had in the face of deteriorating conditions. So it was kind of interesting. It was more of kind of a growth tariff shock, a sort of a headline shock, day after day of throwing more tariffs on this. And if you throw tariffs on us, we're going to come right back at you with more. Go
But
ahead.
also this, I mean, you're right, the tariffs, but also Goldman today lowered global AI server shipment forecast. That wasn't expected, and semis took a header. And that is what also is uneasy for investors, especially after Deep
Yeah.
Six. Yeah, Deep Six.
You're right. You're right, because it was sort of, thou doth protest too much, right? We sort of have this deep seek, and then everybody comes and says, no, 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 that's different. They're sort of skewing the reality of that situation. Don't worry. All the tech companies came out and said we're going to continue spending. Jensen Huang came out saying, hey, Wang came out and said, hey, we're no problem. We don't see any problems here. And so there's sort of this kind of urgency in getting this thing back on track, this sort of theme back on track. But every time we get a rally in these names, we seem to get our hats filled very, very easily. And so big pullback in NVIDIA today, as you said, due to headlines. But some of those stocks, like I'm looking at Broadcom, I mean, it's just about breaking the lows that we saw a couple of weeks ago. So these are not healthy stocks. This isn't sort of in the midst of a healthy rally, we're seeing a headline kind of knock us down. This is stocks getting knocked down that you think would have incredible strength at fairly reasonable valuations, getting knocked down to levels that we haven't seen in, I don't know, pre-August, pre-July. We're getting very close in some of these names. Now, NVIDIA has really hung in there. I think that's kind of, it's the leader of the bunch. And I think you kind of go with the best breed, I suppose. If you have to own one in a very kind of bubbly market, you can own everything. But in a difficult market, you want to own the very best of the very best. So maybe NVIDIA benefits from that. But I'm not convinced. I would not be long NVIDIA right now. I'm not feeling very good about it. I think you and I talked about it, that we could revisit the low hundreds and even the 90s at some point, not because it's a super, super expensive stock, just because sentiment, and that's what investors have to understand, that this isn't just about valuations, about sentiment. And on the way up, we overshoot on really, really, fantastic prospects. And on the way down, we can overshoot as well. We can say, well, NVIDIA is worth $95 fundamentally. Well, you can bet it's going to go to 85 then when things turn around the wrong way. So it's been a very interesting kind of market, some nice rallies.
Before you continue, let me just show one chart real quick. The other part of this isn't just sentiment because of chips and AI, oh my, but also market returns. You know, this thing that I have, money goes home. This is where it's going. So US is down 3% year to date, but China's up 19%, Brazil 16%, Germany 18%, right? This is the defense QE that they're spending money because US, Trump won't on defense and on Ukraine. You go right down the list. That is absolutely the definition of money going home in percentage terms relative to the US stock market. Continue.
Yeah, there's no question. And I'd love to hear your views on that. I know you've expressed them to members, but of course you're always generous during our power hour here. And be interesting to wonder about, is that going to continue? Is this sort of idea of the at least periodic end of US exceptionalism as we continue to push into, you see what Germany's spending. I mean, it is dwarfing. I've got a chart here somewhere. It is just, dwarfing kind of spend on a GDP basis that we've seen from countries in a long time. So really some big money being spent. I don't think Europe is all that great, and I don't think US exceptionalism goes away, but I cannot, fight a trend which is clearly a very strong one at this point. So, that's the difficulty. You have to kind of separate the sort of, underlying fundamentals from what the market just wants to do. We had some I think it's been very mechanical actually since we started getting quite a bit negative around 6,000. We've really had this big kind of Vega, Gamma sort of push down, very kind of mechanical because of the tail and the dog that we always talk about, how big derivatives are, how big option markets are now, sort of helped to push us down. All the synthetic Gamma as well, right? All those levered ETFs. Well, where are those ETFs positioned in the stocks that people like to trade back and forth? The ones with lots of.
And remember, the ETFs can also rebalance abroad. It doesn't have to be US. So,
yes.
And that's clearly what they're doing. And by the way, CTAs can do the same. Just in that key word that you just said made me remember this post that I had for clients, which was mechanical flows versus money goes home, right? So money goes home is a theme for several weeks, actually months, because I said when Trump comes in, there's going to be tariffs and there's going to be deportation and the dollar will fall. They need it to. That is their baseline bet, is they want the demand for dollars to fall. They need yields to fall. And long story short, they're going to go chase yields sales abroad, and they're going to use less of the petrodollar as a means of exchange. They've been settling in gold, etc. But the point is, it has just been confirming. So pre-Trump, after the election, into now, we see it. We really, really, really see it. In fact, Deutsche Bank came out and said foreigners hold a record amount of U.S. stocks, and they have just started selling. Deutsche Bank says that there could easily be $1 trillion of foreign selling. This is way bigger than the corporate demand, which is the usual biggest buyer, right? Where we have all these corporate buybacks. Anyway, this is an estimate of foreign, again, money goes home based on their estimates. Not only that, but we do have 18% of foreign interest in the U.S. equity market. It's interesting. I found this chart, which is, it is 18%, but in U.S. dollars, it represents 25%. So we have some risk as it relates to the sale of equities and why the VIX has not, exploded past 30 like it did during the FX currency drama of July. July was the yen carry trade unwind, and we had that VIX spike to 35, and we had that convexity rally after the 1 month of selling, right? In the same way that we had a similar percentage return drawdown in the Qs between July, 15%, into the August 5th low, and most recently, the mid-February into the mid-March. We had the same percentage terms, but no volatility. Very, very different creature, as you're just talking about. Why hedge when money's just going home? So Chris is a quant and had the same comment recently. Option pricing in every metric on the planet showcases that nobody is aggressively hedging or panicking. And this is the U.S. equity outflow, which is the largest, relative to the COVID crash, which, by the way, they came in and did policy intervention. Same thing with March 2023, which was the backstop. Remember on that Sunday evening, the White House, the Fed, the Treasury, they all came back. They came out and said, we've got your back. Every deposit is safe. That was a Silicon Valley Bank debacle. Those were policy intervention levels that helped money go back in to U.S. equities. We don't have that right now. I have a big question march over, to 2025. Equities have left. You can see the returns that I just showed you abroad. So we need some reason for them to come back in. And why? I mean, right now, the point is that they really are looking at tariffs as a way of, meaning the Trump administration, Besant has been out. Mirren has been also on the TV circuit with Lutnick, the whole crowd. And they're just saying, we've got to reverse trade deficit. We have got to get a trade balance. In order to do that, we're going to have to go through detox period, but dollar's going to have to come down. Yields are going to have to come down. They keep telling us that it's going to be disruptive to the equity market, but the equity market doesn't really want to hear it. So we get unfortunately, we get this mercurial president as well, who uses this time to make sure that he has negotiation bandwidth here. Market's not falling apart. It's not breaking out. And long story short, we really have a mercurial market, and option flow has been limited in its helpfulness because everyone's kind of waiting to see if he's really going to follow through or not.
Yeah. And so that's the thing. We've had a nice rally here. When we talked about it, maybe getting 150, 200 point rally, which we got on the backs of a lot of structural things that we were sort of looking at, which is the relaxing of vol and sort of upside pockets where there was certainly some room for those ETFs to kind of pile in. Although we certainly didn't see massive runs in MAG. We saw some runs in a few names, some of them getting filled in pretty quickly, though, even in strong names that I love, like Meta, getting filled in pretty quickly. So we did have these bounces, but look, we rallied almost 5%. We were down 10%. We rallied almost 5% to what were we down? Maybe 2% on the year. So, I don't think you can complain if you're an equity holder and you're sort of looking at this market, given the backdrop, which is chaotic and uncertain to say the least, and you're down 2% on the year. I mean, that's pretty decent. So I guess we kind of maybe ran into some of that reality today, which was the freight train, the light at the end of the tunnel being the freight train that we kind of forgot about for a bit. But mechanically, we had every reason to rally. We sort of had all these things. So to me, it kind of highlights the fact that these things are very important, and you need to pay attention to dealer gamma, and you need to pay attention to all these sort of things, the synthetic gamma, and all these things below the surface that are really kind of pushing and pulling markets right now, and probably kind of helping to keep volatility, really the vol gauges relatively contained. Here's your VIX, didn't get above 30 here, even in credit markets, pretty as Dave Bloomberg says here, keep calm and carry on. So very kind of orderly
It's
and
interesting on the
overly
credit
bearish.
markets. There is something, a little comment on the credit markets. I do
Yeah.
look at it every single day, but I will say equities lead credit until credit becomes untethered. And it's not so easy for it to become untethered because it is very much held by very, very few. Think BlackRock. It's like volatility. It really is a suppressed kind of area because it has such concentration of ownership in that market. Just like
Right.
volatility is kind of a, as you know, it's kind of made to go down and it's a suppressed vehicle.
Yeah.
But
It
we
is. It's been reverting, right? And I've had some people reach out and say,
yes,
"Oh, I'm
mean reverting.
frustrated. My VIX, structures aren't performing as well as I thought they would. We've got a market that's certainly sold off from 6,000 to 5,500. I'm not really getting the punch out of that." Well, you got a reasonable amount. It just wasn't oversized. We're sort of thinking, boy, the VIX is now going to react like it did in August, and it just that was a bit of maybe an outlier that is reserved for when people are really wrong-sided, right? That was sort of nobody owned hedges, and you were talking about it at the time.
No, that was
No one
that
cared.
was a global margin call because of
It
yen
was.
carry trade unwind that met basis trade unwind because oil was crashing with yields and yen and was spiking higher and they had no choice. They
Right.
had to close. Yes, close or be closed. It's that simple. That was a global margin call. We don't have that right now. We have
Yeah,
sellers.
you're right. There are certain situations that I've been doing this long enough that I remember all the, there is, you have no choice. There are markets where
Yes.
you have no choice. You need to raise liquidity. You need to do things, not because you think you know that you're right to hold on to those positions, but you have your risk manager's giving you a tap on the shoulder and saying, listen, sorry,
Yeah.
but we can't keep doing this. So there are situations, and that's what always leads to sort of black swanish type things, because that's where markets can decouple from fundamentals and from the notion that, well, logic will prevail. But at times things will get so ugly that logic no longer has a place in the conversation anymore, and people just have to get the heck out of Dodge with positions that are going wrong. And so that's part of, and then all those things you're saying also met with people who just had thrown the concept of owning hedges out the window. We saw skew very, very low. And so it was basically a coming together of many, many different things that just sort of created this sort of mini Volmageddon. So, things are a little bit more orderly now.
Controlled. We definitely have controlled demolition. That was a word, but the point is we definitely have opportunities for chases on the upside and downside. The problem is it's jump risk. It's Trump coming out with a tweet implementing tomorrow, or I'm threatening to double the double, or it's, oh, we've delayed it. So this is incredibly mercurial, makes it much harder. And that's another thing. Markets will, wear you out. So in this particular case, so they have a lot more time that they're going to serve than maybe investors have interest in playing. But for right now, there hasn't been any reason for US investors, I'm big picture, to really give up the ghost of higher returns. And yet, I will say, I still say this is topping is a process. And as we see at the beginning of the year, so many big houses had 7,000, 7,200, 7,500,000 for their SPX target. And I did my post. I am not ordering a 7,500 or 7,000. I forget what it was, hat. I'm like, absolutely not.
Cancel that order. Cancel that order.
Now they're re-rating some earnings enough where these big houses, Barclays came out and said, okay, we're not going to go with 6,900. We're going to go with 5,900.
Wow. Oh, I didn't see that one. That's a pretty good
that came out today. So, but then you have other analysts that are still not seeing the decay. They're seeing some re-rating in, like, for example, what you call the balance sheet heroes of the Mag 7, 10, whatever, that right now have gotten cheaper. So they're still trying to get in there and buy, but it seems to be the exodus of money goes home, doesn't really care what the earnings re-rating looks like. There are many other places they're hoping there'll be other places that will reward them with their presence. The problem is they really don't have the same type of market that we do. Not the liquidity, not the variety, not the financialization. I could go on and on. So many are also hoping that will come back to the US. That money flow will come back to the US. So they're not
I
leaving.
I think it will. I think it will. I think we've seen small instances, maybe not like this over the years of, okay, everything's undervalued versus the US. And then everybody ultimately comes back to the US. We've got all the best tech companies. I say we, I'm not even in the US, but I say we've got the best of the best. We have Shopify up here and Nortel. Oh, wait, Nortel's gone. So we don't have
You have
Nortel
my
anymore.
favorite product in the entire world. I'm
Yeah.
telling you, maple syrup.
We've got JDS Uniphase and Briex. I don't know if you remember Briex, but that was pretty interesting. I just wrote an article on how I sold a straddle on Briex at when it was $4. I sold it for $3.50 and I lost money. That shouldn't happen. You shouldn't lose money, but they went bankrupt. And it was an early lesson for me and folks listening who like to trade super, super high option levels and sell high options just because the implied volatility is very, very high, be careful. It's high for a reason because, suddenly you could get sideswiped by a bus pretty quickly. And so for the way that I've taught people and LaDuc members and other students is, I like to look for volatility in a certain range. I don't want super, super low. I don't want super, super high because that to me is an indication that something might be going on there and I'm not interested. So I have lost money selling 350 implied volatility. And I try to stay away from doing that as much as I can. I did it on Research in Motion once and I felt really stupid. But here's your US exceptional is, money going home. I don't know what you think of this. We've sort of a little bit of convergence of GDP growth as well. So growth for most countries accelerating, closing.
And we get our Q4 2024 GDP tomorrow morning with jobless claims.
Yeah, there we
that's
go.
also
So
a
we're
little
going to
market risk.
Well, that's it. So I think mechanically the markets come back here. And so now we're at a point where I don't see any compelling reason except maybe some massive short covering that pushes us to 6,000. But now we're going to get back to the point where some mechanics have played out, some Greeks have played out, right? The Greeks that we talk about all the time have played out. And now we're back to where we're going to be a little bit more data watchers and kind of seeing if there's any credibility to this idea that we're continuing to slow down aggressively. Has this been a real overshoot? Because you have to admit, people can just kind of panic because there's this shock and awe kind of impact from headlines and everything that's been going on that were completely unexpected. And so people kind of go, including companies, they go, okay, hold on a sec. Let's just sit back and wait a moment before we get back to business and start investing and doing things that we need to do. That can dissipate as well, right? As things kind of calm down a bit. So
but are we really at risk, quote unquote, are bears, I should rephrase this, are bears really at risk of a short covering squeeze? I would say no. And here's why. I mean, only 2% of NASDAQ is short, but the point is we can already see from skew, right? It just collapsed. And the whole thing is a structure. Dispersion trades, what really, really got bid up on Monday, which helped the market tremendously, wasn't just the headline, which was Trump saying, we're going to do something different. We're going to restructure it, whatever. It was a positive tariff headline, but it was also the dispersion trades. Instead of heavily, hedging SPY, and of course with VIX just falling nonstop since Tuesday or Monday, Tuesday, February 10th or 11th, whichever one that was. And it hit 29.56 and it was a 2-bar reversal on a live
March
trade.
10th. Yeah. March 10th.
And I was like, literally, this is where we go down into options expiration. So that worked. Did I expect it to go all the way down to the 200-day? No. So the point is it then overshot to the 200-day yesterday, Monday, Tuesday. Yes. And that's when I said, be careful. Now we're going to start come back up. And you could see it with VVIX. It closed up 7% yesterday. But my point was SPX wasn't really the game. It was the dispersion trades. It was Tesla was heavily short, heavily short, not just all the geopolitical stuff that's going on and scratching and whatever. It was really the structure on Tesla from a dispersion standpoint was the most short of all the Mag 7 stocks, bar clearly. And that was the short squeeze. I don't see a short squeeze potential like we had in the yen carry trade. I don't see it in NASDAQ and SPY. If we get a move higher, it's going to be jump risk because tariffs are removed or once again delayed. Literally, Trump comes out and says, I was just kidding. Something like that. And it's going to drive sentiment and they're just going to start chasing above 58.50, 5900. Then we're going to get up to that 6,000. Then we're going to get hit right in the face again. But I don't see this as anything more than dispersion short covering.
And it could be, you're right. In fact, I think a big move to the upside, you'd probably see volatility kind of hang in there because it's not really expecting that. And I think the upside is actually a little bit cheap again. Everybody's kind of positioning heavily in single name downside puts, and the upside is being ignored a little bit. Left tail, right tail, kind of ignoring the right tail. And so we're seeing skew really, really relax suddenly. And what I will say is that the mechanics that we've been talking about since about 5,500 or 55 and change in place. So if we look at vol targeting, for example, these are the funds that buy when volatility is low and they sell when volatility rises. The volatility has risen. Of course, we've seen the ATRs really expand. Volatility has risen. Everybody can follow those with Bollinger Bands and ATRs and stuff like that if you don't have a volatility chart. But we're starting to crack a little bit. And as time goes on, we're going to lose some of those big down days, right? Some of those down days drop out of the samples, and we start getting this dropping a bit more. And so what that means is these funds have to start to allocate again. So on a reasonable, if things kind of stay relatively calm, which I don't see us cracking quite yet. I think we need more data. We need a little bit more time. So I'm kind of thinking we rally near the lows today. I told a couple of people, I said, I think we rally into the end of the week. So we'll see if I'm right or not. But I think we have some stability here. Also from CTAs, there's sort of not much to do here. But if we kind of stay stable, they could start to come back in and up a little bit. They could start to come back a little bit. Now, if we break for some reason, then it's game on again, and all these things start to unravel. So that's our world, where we're kind of sitting on the fence sometimes, waiting for things to accelerate one way or another. I kind of feel like there's still sort of this pain point slightly to the upside. I think we've made most of the move, but I think we can maybe stay stable. And maybe that's part of what the VVIX and the VIX have talked about. I did say that last week at some point. I said, I think we kind of trade between 5,600 and 5,700 as we get closer to April 2nd. Now we pushed through there yesterday or last couple of days ago, but now we're back down in that range. And maybe we find a little bit of stability here where the VIX actually starts to settle down again as we wait for whatever this day is going to be. Whatever it is, it sort of represents something for the market to kind of hang its hat on and say, okay, there's been a lot of sudden headline bombs. Maybe he's going to wait for this particular day, whether it's good news or not good news. At least we have something that we can kind of expect. It's almost like it's a known unknown. We don't really know what's going to result, but I mean, it probably won't be great, but investors are saying, well, we're going to know something. That may be it, right? Maybe we kind of coast into next week. When is the 2nd? The day after April Fool's. He should have done it on
Wednesday.
April Fool's. Next Wednesday, so we've got a week. Yeah.
And honestly, the fact that he pulls all these stunts around dates that really don't matter, if he has not accomplished whatever leveraging position and negotiation position he's trying to affect, then he's just going to change it up. He's going to do it on another Sunday night after his buddies have positioned for the opening on Monday. But the point is, we don't have any safety. We have no edge. We really don't.
They must be making a fortune. They must be making a fortune off of this guy.
They are. So yeah. The Washington Post just came out with a title. Alex sent our contributor, Dr. Alex. U.S. could hit borrowing limit as soon as May. So the CBO is out warning because our deadline for the debt ceiling is September, which is why Besant can't really change the composition of the issuance bills and bonds, short duration, longer duration, until this debt ceiling is resolved. Well, the CBO is coming out and saying, well, too bad. Depending on what we get for tax revenue, we actually could hit our deadline as early as May. So the market will start to price that in because it's a risk. That's a macro risk. We got tariffs, and now we have debt ceiling, and yields are not falling. They're actually rising, which is much more, it's hard to explain this, but it's much more impactful as it relates to all the debt servicing, the interest that we have to pay on this rising debt. And the debt, and I'm not talking about the deficit amount that they've approved. I'm talking about what is being spent, what they're passing to be spent is actually growing. And that's actually the big problem. So until we get control of that, tariffs are part of the plan. DOGE is part of the plan. But if congressional spending is not part of the plan, we're still going to go back into this wonky period, fiscal distress. That's going to also weigh on the markets. So we're going to have a combo deal, tariffs and debt showdown. And both of those things are going to be volatility producing, or at the very least, investors just get worn out by all of this, all these shenanigans. So I don't think it's a really easy market to trade. It's very mercurial. I look all the time for sectors that are going to be really productive. Germany had that big, huge advance, but now it's going sideways and digesting. You cannot tell me that the 10-year yield in Germany is going to hold at that level. China has already started to digest. It was extremely productive as along into this year, but it also got a little ahead of its skis, and now they're threatening reciprocal tariffs. You also have gold and silver, which have been absolutely where folks have been holding out, is starting to digest. So there really isn't a strong, durable theme. It's not back in tech. It's not in semis. They're still rolling over. So
Yeah.
what are you finding for any theme stocks or sectors that you like?
Well, that's here's the thing I was telling you about, Samantha. This Mertz, whatever it takes. He's given us the
Oh,
old
yeah,
whatever it
that's
takes.
true.
So
Yeah.
and then here is your flows into all the stuff, but for the viewers, it flows into Europe and flows out of the USA. So I mean, I think there's room for some of that to unravel. So in terms of to your question, what are you looking at? Well, I like one of the things I wanted to show folks is and I'm using bar chart for this. I mean, you can do this on almost anything, but you do these relationships. So what I've got in here is I like to kind of get a feel for where the money is starting to push into, right? Where is the money kind of favoring at this point? So I've got all the different sectors in here, and you can see XLU kind of broke out a few weeks ago, mid-February, and then we kind of had that top there, and then we gave back as we sort of piled into growth a little bit of Momo for a moment, and we came down to the spot here, and I told some people, I said, listen, this could be a spot where people will chip away, and they did today. Is it going to last? I'm not sure, but I like to look at these relationships here, and I know you love to do this stuff as well in your sort of short, medium, and longer term. Yeah.
No, it's my wonky intermarket. And before you go back to that, I have to show that growth value rotation chart, because this is the one that I often show here, and clients get to see it every single day. This is where we were. Can you see this chart real quick?
Yeah.
This is where we were back in that August. The yen carry trade unwind was very, very, very impactful. Okay. So the August 5th convexity rally only caused growth to move higher for 6 weeks. It digested sideways until September 11th, when NVIDIA came out and Jensen was on CNBC and did a big, brouhaha, and basically NVIDIA made the market. And after it started moving, everything else really started moving higher. So after that convexity rally on August 5th, we kind of stayed under the zero mark, and then we finally moved higher. Things took off again. We had the Trump bump, and then it got completely dumped underneath the surface, which was very, very important. Mag 7 was becoming, not dangerous, but definitely bag 7. And here it is just the other day. I literally took this and said, we're just about ready to have a little growth bounce, right? And all I see it going to is about 2, which is this ratio. It just means, again, this is a ratio of growth to value. And then what do we have today? Okay.
Well, that's the thing, Samantha. Yeah. As long as those moving averages are pointing down, I feel like you can rent those bounces. You don't want to get
That's what we did.
Yeah,
that's exactly what we did. So rented that bounce, because this is exactly where it went, right here to 2, and then it came right back down. So it was a 2-day terrific bounce in growth that got rejected and then came right back down. So that's exactly, to your point, how this rotation under works on a short duration, not the big picture, but the short duration.
Exactly. And look at those short-term averages. I know you like the 8, you can look at the 9, you can look at some of those shorter ones. And when everything's kind of pointing down, don't look for the 3-week rally. It's probably going to be little bounces in there that end up being kind of sold. You're going to sell the rips a little bit, but I like to sort of have an idea of where I got back here again. So we've got the XLU, we've got the XLB materials, communications a little bit. So we've got generally kind of a rising trend here. So even though this is the kind of thing that I'd be looking for, you see a pullback to, let's say, like a Bollinger Band, bottom of the Bollinger Band. But as long as those moving averages are pointing up and this thing is generally moving towards the top right of the screen, then probably not a bad place. XLE, which I have a really kind of love-hate relationship with, mostly hate, but we've passed through here. So this is kind of interesting. We have, for the first time in a while, we've got this XLE. This is the relationship, right? So we're charting the relationship. So these moving averages speak to the relationship, kind of starting to push through that 200. Now, the only thing I'll say is that we have done this before. And so if you look back, we kind of pushed through there, it failed. We kind of pushed through there, it failed. So, I don't know how far it gets going, because I agree with you. I'm not so sure oil is really going to get going, but people are just kind of grasping at straws here for some sort of value. And these are companies that are very cash flow positive. So
I always, when I look at energy, the only way I'm interested in the oil and gas plays, it's really one of, 3 reasons. The underlying is moving higher, which right now now it is not. It's a defense play. It's the only thing that's leading this year to date, right? So
It's
so
yeah, it's the
stocks.
top sector, I think.
Exactly. So guess what? It just gets the carry, the pile-on effect, but that's not a reason to stay in it. And the
Yeah.
third reason is very much like Buffett, his saying, which is, he says, I won't get rich owning energy stocks. I will stay rich because of their dividends. And basically, they're not going to
Right.
go away. You're not going to have Chevron and Exxon ever go away. I have no interest in playing oil bounces through energy. Energy is a pure sector rotation safety play. That's it. And otherwise, there are some individual holdings in the oil and gas space that do better than others, especially early on. We had this whole, data center convergence of money going into WMB, which is Williams, and Kinder Morgan, which is KMI, and even they have been in distribution the past few months. So there have been some phenomenal, LNG plays because of nat gas, et cetera, but they don't last. So unfortunately,
Right.
you got to kind of swing while they work on a theme, and then when the theme ends, get out, like the uranium plays.
Yeah,
And right now, I think
exactly.
energy it's leading because everything else is not.
Yeah, exactly. The money's like water, right? It's got to flow somewhere. So
Yes.
you got to monetize, right? It's a bit like VIX. You got to monetize. It's sentiment. It's quick knee-jerk reactions. So here's staples, a little bit similar to utilities. Utilities has some kind of AI sort of
Yeah,
influence in
the
there. So
power producers
from
and
the power
data
producers,
center. Yeah.
which I like, but that's another sort of confusing narrative as well. So you have for every person that comes out and says, well, we need 3 times as much energy over the next 5 to 10 years. Another person says, well, that whole theme is really fraying because we're going to get more efficient. We're not going to have to spend as much on AI, et cetera, et cetera, et cetera. So we can't just kind of take everything at face value. So there's a little bit of uncertainty surrounding that as well over the longer run for trades. I think I really love power gen, but here again, bouncing off consumer staples versus the S&P, bouncing off quite nicely. Healthcare, we've got new problems, right? Because I think they were talking about maybe not being able to advertise on TV, and they didn't like that. So those are kind of those tape bombs that we don't know are coming. That's part of this new administration is we don't know when something's going to be disruptive in a way that we hadn't even considered. I mean, I don't think they're gonna do anything like that, but if they curtailed pharma's ability to kind of advertise and things like that, then that could be a big deal to that sector. So I'm kind of looking I'm sort of looking for areas. My favorites as well, like Netflix. I bought some leaps on Netflix and I'm up 47%. I tried to sell this morning and I didn't. So I gave back a little bit today, but I'm trying to kind of focus in areas that I think are relatively shielded from, especially if you're in technology, you want to make sure you're relatively shielded, right? There are yeah.
Go ahead. Versus.
I was going to say things like software as a service, I think is a little bit treacherous right now. Like I don't know how AI is going to disrupt things like Adobe, for example. How is a company like that going to be disrupted when you can just tell AI to make a PDF, and here, I've got a program that I use for, thumbnails and things like that. And I just tell it to do this and boom, it just creates it. So there's another 10,000 Fiverr, employees in from Pakistan to India to wherever that are just, now they're out of work too. So, AI is disrupting in such, deep ways that, you have to kind of have eyes in the back of your head a little bit as an investor, especially in the digital space and technology. So I think there's kind of these potholes in technology now that I think relate to disruption itself, disruption from what's happening in AI and maybe quantum at some point. And so maybe there's a sort of move. So I'm kind of looking at real physical things. Like, I know you don't like Home Depot because of what's happening in housing, and so I'm not necessarily picking that one, but things you can touch and feel. Maybe we get a movement back to touchy-feely type things again, things that are real.
Well, it depends on the time frame. I mean, right now, things over paper has been a really solid theme of mine since COVID because of inflationary impact on real things, car, houses, etc. And now we've got tariffs. You've seen what's happened to the price of copper recently, lumber recently because of tariffs. It isn't a supply demand issue at all. It's tariffs. So the other kind of aspect of this is the tech plays and which ones have more room to fall. I actually, and I hate to be on the other side of the trade with you, Hans, but Netflix to me is the one Mag 7 stock that absolutely did not succumb to as much selling as the others. So it held up and it bounced quicker. I think it's the next one to roll over. I think it's the sitting duck of the Mag 7 because it didn't get as much of the treatment as the others. And if anything, it's kind of like low-hanging fruit for lots of juicy option plays too, because it's right into earnings in a few weeks. When is it exactly?
Yeah, they're
April.
coming. You're right.
Right. So I love this as a short idea.
The question,
I mean,
the question is going to be, right?
Crazy about this as a short idea.
They had massive new subscribers. I mean, the earnings were fantastic last time, but was it the Tyson event? Did people come for Tyson and stay for Squid Game season 2 and for everything else, right? In my view, it is a place of safety because anybody can afford $7 for literally unlimited entertainment. It's going to cost me $200 to go see the Raptors, and they'll probably play crappy. So for $7, I can watch TV all day long, 24 hours a day, so my eyes pop out of my head. So, but we'll see on those earnings, and we'll see if they're still making headway.
I think they might be just as good as they get. I mean, I'm not even gonna comment about Disney and the other, Roku and all the other streaming and Paramount. Oh my God, they're on the floor. Netflix is not going to be saved by money goes home theme. It is not going to be saved. It is going to be ripe for picking. And it was actually a fabulous short from 977 down into about 870.
Yeah, it did fall back.
It was gorgeous because it had a particular structure I really liked. So it had a gap fill that also I really liked on lower before this earnings pop. Anyway, long story short, I think the next earnings will be very telling, but I think it looks like a good short.
One interesting thing, I'm looking at MSTR again. Every now and then I love to look at MSTR because it has, it has lifetimes. It has lifetimes of vol moves in a few months. So that's what I like about it. There's always a learning opportunity. What's interesting lately is that we've had this really big rally and implied volatility. So option pricing has really been crushed. Now, I know part of that is because the VIX has been crushed as well. And there was a lot of fear down around that 250 level. So, but this is rather unusual for this thing to kind of start rallying up and the vol to come down. So I'm starting to look at some long option plays again in something like this, given that it is one of a few option classes out there where volatility has dropped quite a bit, but it has the potential to really, really move. Now, Bitcoin is kind of getting around that 100,000 level again. So I think if it doesn't break away from that one way or the other, it maybe we kind of sit around. So maybe that's what option pricing is telling you, that we are going to sit around for a little bit, but that becomes interesting for me again. I've done 3 of them. I won on one big, and I kind of broke even on one, and I lost small on one. So this isn't a play that I do a lot, but every now and then I like to get into the long options game, which is actually where I've made a ton of money as a market maker, because long options was really the way to play these swings. I always hated being on the negative gamma side of things. It's not a lot of fun as a market maker. So you always try to position yourself in the most favorable way possible, which tends to be long gamma, because then you can play the swings. When the market goes up, you're doing well. When the market goes down drastically, you're doing well as well, generally speaking. So I'm kind of looking in there. And then I wanted to bring up gold because I know that a lot of LaDuc clients have gold and silver, and I know some people
and silver. Yep.
And silver
and
as
miners.
well. And the miners, which they finally started going again a little bit. Gold kind of interesting structure, right? It sort of looks like a regular stock, which is downside is more expensive than the upside. Whereas under normal circumstances, the upside is more expensive because of that explosive potential. So right now, under normal circumstances, it's sort of favorable for buying callers against your holding, which is selling upside calls and buying some downside, because you're sort of selling the expensive, buying the cheap. Right now, it's kind of the opposite right now. So not as good for that kind of structure, but you could buy put spreads in something like this. And quite frankly, the implied vol isn't very high on it, right? So it's kind of sitting around 3,000. And I think it's getting rather cheap from a protection standpoint. So if you are worried that we get back to, I don't know what levels you have, Samantha, but I think if it gets going, it's not going to be a one-day event. So if you can, gold really wants to kind of settle down a little bit. I think we could see 260 275 fairly easily down here to 290. Oh, that's the GLD, right? GLD. So, you know, the implied vol is never very high on it because in the grand scheme of things, it doesn't really do a whole lot, except once it starts trending, it just kind of trends. And that's where probably the opportunity is in just buying upside calls and sitting on them, which we talked about months ago. I've had a few members say, well, what should I do? Well, it's kind of cheap. It's cheap to the upside. And I hate to sell covered calls into cheap implied volatility because to me, you're just getting in your own way. And so I don't know if I have the chart here, but it sort of showed, it was a kind of a cool illustration of what really I think people should take to heart when they're options traders and people who like to do covered calls and cash secured puts and different more complex things. This really showed that the options market more than ever is very much a world where calls are very supply driven, which means that the calls get pushed down. So those implied volatilities, the option pricing gets pushed down, which often makes calls a little bit inexpensive. And that's why covered calls are very difficult. It always feels good when one works out. You go, oh, great, I put $3 in my pocket. But then, you know, the next one kind of runs through $30 through your strike and it costs you $30. So we like to remember the wins, but the fact is that calls tend to be compressed. Now, that was very much a fixture of 2010 to 2020. So because that was a very low vol environment. Remember, we had QE, we had constant stimulus. The Fed put was all over the place, was practically at the money. And so, you know, although 2018 we did drop a little before it kicked in, but those were years of real option compression. Are we in a little bit different environment? Yes, we're probably a little bit different. Before 2010, covered call studies basically illustrated that they were actually positive on a portfolio overall. So from say like 1990 to 2010, they were sort of a positive influence. But in this new era of massive AUM in covered call rate funds, in caller funds like the JPM caller, they sell calls to finance some downside. We really have this sort of supply driven upside, whereas downside puts are very demand driven. And that's part of what creates skew out there, right? So there are
Explanation.
Two worlds that people really should understand. That's really what makes, when people ask me, oh, I want to become better at covered calls, I say, you know what, it's hard. You really have to have so much going for you. You've got to have some trend lines, you've got to have some idea of fundamentals, you've got to really pick your spots in order to be right. Whereas trading the downside skew is usually cheap. The market doesn't usually realize what is priced into downside because downside is usually priced too high. And so that's really where the opportunity is. So that's how I sort of explain it. And especially when we get into a low vol environment, VIX 12, 13, 14, 15, you're just getting in your own way when you're aggressively selling calls. It feels like you're really putting money in your pocket, but you're really giving up a lot of upside potential. What do we have here?
Yeah, I was going to say, let me just share, speaking of which, we need to talk about April 2nd tariff deadline and the end of month, which is fast approaching on that 31st Monday. The April 2nd warning by Goldman, speaking of downside demand, there isn't any. How would you position into potential volatility next week? And just if I can get this quote real quick, Goldman Sachs economists note recent media reports have suggested the Trump administration is leaning in a more benign direction on tariffs. Don't be fooled, they write. That attitude probably sets markets up for a negative surprise. And I don't know what Nomura said. You get those, I don't. Goldman notes the Trump admin has seen tariffs as a negotiating tool and will likely want to start from a position of strength. A recent Goldman survey shows that market participants believe reciprocal tariffs coming in April will amount to a 9% reciprocal tariff rate. Goldman itself expects that the initial tariff rate could be double that, which would set the market up for a negative surprise next week.
Does it feel too early, Samantha, for Trump to kind of throw in the towel here? I know it's the art of the deal.
I don't expect him to throw in the towel at all.
No.
Zero. For me, this is not going to happen. He's going to try and negotiate, of course, that they remove their tariffs. So there's no way he's going to give in on anything unless he gets more than what he's asking.
Right. I'll show you mine if you show me yours is going to be Trump's play
and
here.
You first.
And look, I think you first, right? So I think, I think this volatility, I think where the VIX is now is a bit of a gift. And I think when the VVEX gets under sort of 90, 95, that's when the volatility of volatility, so the cost of owning volatility gets low. And so I think it's a bit of a gift here. Like whether maybe you don't want to play upside VIX because it's maybe not as reactive, but it's cheap. Or you could just buy some, you could just simply buy a downside put spread. This doesn't have to be complicated.
I like that
Sometimes,
idea. This is what
yeah,
I really, really think is just easier than
yeah.
dealing with VIX. I know you love VIX, and I can technically analyze VIX, but cows come home. But ultimately, it is just so much easier to throw a directional put with time or a put spread when we have this kind of mercurial market backdrop. So
Exactly. Give yourself a little bit of what we call Vega, right? So you don't want to buy, I was telling, I can't remember who I was telling, but there was this Goldman study showing all these different protective structures, collars and put spread collars and straight up puts and put spreads and different things. And the absolute worst product was just buying short-term downside puts. Now, you could be right. If you call a giant sell-off tomorrow and you just bought some puts, of course you're going to be right. You're going to own a lot of gamma and you're going to get a huge reaction out of that. But the fact is, there's a put spread fund index put out by CBOE in 2022 when the market was down 18%. How do you think that put spread fund did? It bought puts every single month. It lost money. It did worse than the S&P. So a put spread fund that owned downside puts in 2022 lost money. So that is about all the lesson you need really to understand how to sort of position yourself in protection. You want to wait till things get cheap, which they are right now. And if you're long equities, fine. If you're wrong, you're happy to see your house insurance go to zero every year, aren't you? It means your house didn't burn down. Great. So now it's cheap. You can put yourself in some downside puts. It's not too expensive. You want to give yourself, generally, I kind of like sort of 7, 8, 10 months, maybe even up to a year, depending on how pricing looks to me. And you're going to give yourself Vega exposure, which means if volatility explodes, you're going to get that benefit of implied vol going up, as well as the benefit of your delta, which means you're going to make money as the market comes down. So that's how I'd be looking at things. I would sort of look at maybe 10% out of the money puts at about the 10-month mark in terms of the expiry date, and strap some on. Look at your position. Don't spend 20% of your portfolio value, but give yourself a reasonable amount. I'm not sure where it's pricing right now. It's probably around 3.5%, but I'd have to take a look. And that's how you do it, really. And you're going to get what you get. The thing with VIX is it's very sentiment based. The VIX is it's mean reverting, right? As you mentioned earlier, it's going to go up, but then if you don't monetize it, watch out, it's going to come down. But if the market goes from 5,500 to 4,500 and you've got the 5,200 puts, you can be sure as heck that those things are going to be worth a ton of money, right? They are worth what they're worth because they have a strike associated with them, whereas the VIX has no strike. VIX 25 is meaningless versus the S&P. Mm-hmm. Yes, they're correlated, but in the end, it is kind of meaningless because we could go to 4,500 and everybody calms down and the VIX goes right back to 20 and you're not up money on your protection. So there's something to be said for being...
It's another style of trading. There are traders that only trade VIX, but they have very, very advanced option tactics of many, many, many different strikes and buying and selling and basically drilling down that margin. And then they are there for whatever happens and they will monetize no matter what because they are experts in trading VIX. I just, in my little travels of looking at all markets, all sectors, all stocks, it is much easier to trade directionally when I have an edge and then not trade when I don't have an edge. And right now, I think this is a mercurial market. The folks are really trying to figure out, are we going to have a V-shaped recovery? Tom Lee is out always saying we are. But the reality is I don't think we have the market structure to get V-shape unless we have the macro trigger full stop. And I do not see, unless Trump can really, really make China do what it wants, make all these other countries drop all of their reciprocal tariffs, that we're going to have a backdrop without tariffs. I don't think we're going to have a backdrop without spending, but we are going to have a backdrop of more job loss from the government shrinking. We are going to have a detox period with equities, whether you like it or not, because money is going home to chase yields that are rising abroad from stimulus and/or more safety from what we have right now with our mercurial markets. So pace yourself in a different stage, but for right now, we're going to be starting earnings in a few weeks, and we'll get to see a little bit more. I mean, we have to get through Netflix, but my point is that's going to be the big tell also for sentiment. If Netflix is as good as it gets, like you said, then we're going to have some more kicking and screaming by equity holders, equity investors who are like, what happened to my concentration that was so easy for the last few years? It's going to get harder. Yeah. They're going to have to go into other things that are kind of like, I don't understand industrials.
Right. That's right.
I don't understand any of these other things. I know what Netflix does. It's going to be much more work, and I don't know if they're going to want to do it, but we'll get there.
And value is making a big comeback, Samantha. Looking around the world, value is exploding in interest.
That's all
So you're
they
right.
have.
We're gonna have to go from, I was a Ukraine expert. I was I'm now a tariffs expert. There's no question about it. I'm gonna
The
have to
Hang
become a
Seng
value
Tech
expert.
Fund, the Hang
Yep.
Seng Tech Fund is hot fire flames as it relates to great shopping. Jeffrey, again, he's been leading the band. We've been trading that sector really, really, really well. But now it's also time for digestion as this trade war gets, a little bit more heated.
Right.
And long story short, unless you go to the Hong Kong exchange, which you can do through IBKR, you don't get the same margin and leverage, but you will have also the headline risk for those who trade China. They're still going to trade it in the US, but you're still going to have the headline risk around a Trump executive order on the evening of Friday the 21st that says don't invest or else. And then Besant comes out just last week and says, yeah, I'm going to have my office look at ways that we can actually regulate investment in China. They're not unserious about this. They're actually very serious about this. So I think it's really tough, even if that's a great sector to go in for tech. We're talking AI tech in China. We're going to have some headwinds for as U.S. investors to
Jason mentions VIX just trading vol. That's right, Jason. It's just kind of a trade. It's real. It's a real thing. It's real money, but it is. It's just a different animal. And Utkarsh is asking about Tesla and Meta. I think Samantha talked about Tesla earlier. Meta is one of my favorites. I think it can weather the storm a little bit. Out of all the MAG, I think MAG's a little bifurcated right now, right? I don't like NVIDIA. I like Meta. Microsoft is kind of meh, but I kind of like it. Tesla is a complete whack job. So, and Google, I want to like it, but I can't. It's cheap. It's the cheapest of the bunch, but I can't like it. It has too much. And I love Amazon. I love Amazon. Amazon is cheap. Amazon is cheap. I was comparing it to some stock the other day. I don't know if it was Walmart. To me, it's a reasonable stock. So I think it's, Meta probably subject to ad spend. I agree. It is somewhat, but I do believe that I think people do move their ads to Meta in tougher times. I think they have to go for the best. They have to go for the very best for what that's worth. I think they start hoovering up a lot of that business that maybe has been going or has been spread around. Think of yourself with a budget. You have a smaller budget. You go, well, I better put it to the absolute best use possible. So I think they can still do okay. And I don't think they're insanely expensive, right? It's down from 735. It's pulled back. What's that, 20%?
But it also depends on people's time frames. So a lot of these questions like TLT, oh my goodness, we have right now, rising 10-year into my 4.44%, overshoot to 4.5%. But then I think it gets rejected because I'm still seeing a deflation impulse that's going to come back into the market. So it really depends on time frame. I'm looking at the yield curve, 10 and 2 year. I show that every single day for clients. I'm really, really tight with where it's going to flatten and where it's going to steepen. So I'm very into, but these are much shorter time frames of several days, several weeks. I'm not looking at TLT as a multi-month trend reversal higher project. Anyway, the point is, this is the kind of stuff that we do every day. You can also, for educational purposes, LaDucTrading.com/Hans. He has fabulous options, education, and mentorship programs. We have our Slack workspace for clients, live trading rooms, direct engagement, 10 contributors. So come join us at LaDucTrading.com and we will talk to you another time. But for right now, I think we covered everything we got until basically next April 2nd. And Trump's not going to make it easy. He's going to come in early or late, do a little bit of his mercurial market moves. And that's what we're going to title this. Until further notice, thanks everyone. Have a great rest of your trading week and end of month.
See you, folks.
Cheers.
Thanks, folks. Bye-bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.